I'm going to give you 3 big things to watch out for when you're looking at investing in somebody else's deal. All right, real estate market, everyone thinks it's hot, they think it's the top of the market. People are afraid to get in. And especially now when like those tenants, they're not paying. So what do people who want to get involved in real estate investing do? Well, a lot of them look into syndications. What's a syndication? It's basically everyone pools their money for either one like high-rise condo, which you've probably seen, or in other cases, it's a fund. So it's like a collection of assets. So I'm going to give you 3 big things to watch out for when you're looking at investing in somebody else's deal. Number 1, always talk to the actual manager. I'm not talking about like the side guy, the guy who's hired to pick up the phone and like talk to investors and collect them. I'm talking about the guy who's boots on the ground, who's making the buy, the purchase, the rental, property management decisions, that guy. Because a lot of these big syndicators, some syndicators who have their own jet, you can never talk to them. You'll talk to their side guys, which is cool and all, that's big business. But personally, from the calls that I've made, there's a big difference when you talk to the guy compared to the little guy. Number 2, watch out for big words like IRR, internal rate of return. Yeah, internal rate of return, yeah, it can mean something, but it's also dependent on when the exit is. For example, an IRR after 5 years is very different than an IRR after 10 years. Another big problem with IRR too. IRR is calculated with 3 things: the purchase price, then the debt service with it. Number 2 is the monthly cash flow. That's what everyone's familiar with. That's something syndicators mostly can calculate based on market averages. And number 3 is the exit price. IRR is just a guess until it's actually sold. So be very careful with big words like IRR. Even worse is equity multiplier. But again, how do you know when your equity has multiplied? If the manager doesn't sell, they haven't realized the new equity. They're just guessing. And number 3, syndication, like I mentioned, with one asset versus a collection, a fund of multiple assets. Everyone's heard Warren Buffett. A lot of people who invest in the past, they talk about diversity, right? A fund has built-in diversity. For example, a fund can own short-term rentals, multifamily, long-term rentals, parking lots, anything that's on real estate property, even land. Fund managers have the flexibility to move with the market. If the market's saying that single families aren't working at this time, they can quickly dispose of it and use the same fund money and now purchase multifamily or anything else that's working at that time. Super important. You want that flexibility, because if you just own one asset and that one asset comes crashing down, so does your investment. These 3 things and more is what's guiding myself and Tyler Chef to build up our own fund from lessons learned. If you'd like to learn more about what to look for or what Tyler and I are giving the accredited investors the option to invest with us in, schedule a call with us at Key West Cashflow/call. And yes, we're investing in one of the hottest markets in the country. And we hope to see you there.